Folks, the recession's canceled. We're in a new bull market. Stocks and real estate prices are gonna make all-time highs. But is that really the case? I like to look at history and find similar times of situation that we're currently in economically. And when we go through this history review, I found this very important metric data point that has had just outstanding forecasting of what's going to take place. And it's something that economists, the institutions, corporate executives all take a look at, and it can give us some guidance on what the current situation is. So I want to talk about right now is the yield curve. What is going on with the yield curve? What does it mean? Where are we at in time of this economic cycle? So to understand this, we need to understand what a yield curve is. When a company issues or the government issues debt, for example, you have your treasuries, your bonds, you get an interest payment for buying or investing in that debt security for that company or public institution. So I'm going to give you an example of a normal yield curve, and it looks like this. So you buy a 1-year treasury bill, you get, for example, 5%. You buy a 10-year treasury bill, you get 6%. You buy a 30-year treasury bill, you get 7%. So your shorter term, you get a little bit less. The longer term, you get a little bit more because you're tying up your money for a longer period of time. What happens when we see an inverted yield curve? Now, this is what that means. That same 1-year bill gives me 5%. Well, your 10-year gives me 4%, and your 30-year gives me 3%. So it goes down. And what does that tell us in history? It tells us the economy is sick. So asset prices shooting through the roof does not negate the fact that under the hood, the economy is sick. So I want to show you guys this. Let's take a look at this inverted yield curve history through time. So you'll notice the magenta shaded areas are recessionary period. This chart goes back to 1977 until we are currently. The numbers 1, 2, 3, all the way to 7 are inversion periods. And you can see the inversion periods are followed shortly thereafter, those recession periods. And it is astounding how accurate this inverted yield curve is. And something else that I want to highlight, you'll see below there, the unemployment rate. What happens to the unemployment rate as we are in this inversion period? Unemployment rate goes down. The trajectory is down until we're like right before recession actually hits. So what we're seeing in the news, jobs are good, unemployment's down to a historic low. These are normal for pre-recessionary periods. And not until we're actually in the recession do you see the job losses spike up. But the inversion takes place. So the inversion in 2022 took place March of 2022, and then really took place in June of 2022 that sped up that inversion. So on average, 12 to 24 months from when that inversion takes place do we actually see that recession be fulfilled. So we're in this window right now. We don't know exactly when it's taking place. All we know is through history, we're probably getting closer. Now there's an election next year, politics, they could print more money, change the dynamics of this, of something that we haven't seen before. They also printed 80% of the money supply in 2020 and 2021, things we also need to be aware of. But we need to be aware of what history tells us. Here's a quick article on the performance of the inverted yield curve. So you'll see right here, inverted yield curve, is it still a recession indicator? An inverted yield curve has accurately foreshadowed all 10 recessions since 1955, according to the data from the Federal Reserve Bank of San Francisco. That's just telling us that this metric, this data, has been very, very accurate through history in the last 70 years, leading back all the way until the Great Depression. You've seen it at the end of the 20s as well, that inverted yield curve, and then 1930s did not go very well. Not saying today is going to be like the 1930s. It's just something that we need to keep in mind. There's a lot more data points that you need to look at in conjunction with this to really confirm your thesis and thought process on these ideas. And there's also another great thing to do is be prepared and don't ignore such a high probability of a data point. If you go through history, there are a lot of things that you can invest in, put your dollars in to protect yourself if this high probability scenario based on history does take place. Don't ignore this. Be prepared. Thanks for joining me. Expertise you deserve, experience you can count on.